it's not going to change anything kind of in the short run, but it's going to be interesting how it plays out over kind of the whole of next year. We already have bond yields or in the US being higher than in the Eurozone at least, and that has not stopped yields from being on a similar level as they are in Europe. So whereas that trigger point where a bond yield is at a level where it actually pushes out yields again, and that's an interesting one to watch, and not just we're watching the UK usually as a kind of the bellwether market for the rest of Europe, but in the same way we're watching the US because US capital markets just are the ones who is setting the tune for the rest of the world, and in that cycle they're definitely moving ahead of everyone else. So we have the benefit of we can watch what's happening there and then see and adjust our behavior, our investment behavior in Europe.
Okay, good. Marcus, you wanted to come in on that, did you?
I think one other aspect possibly when looking at interest rate rises is I think the Fed little bit of missed the point when they should have started raising rates, because now everybody expects the Fed to raise rates. But I think it's a little bit of also the question, if you look at how long the expansion in the US economy is going, when will the next shock hit and how far can the Fed really go with interest rate rises until these external event or some internal event might occur again. I think that is also a little bit of what markets are pricing in rate rises, but we also have to question ourselves, what is the overall economic situation of the US after a 6-7 year recovery, and how long will the recovery continue and how far can the Fed go? Because I think underlying structural issues, not only in the global economy but also the US internally, might not lead to a situation where the Fed will move very quickly. So it will be a gradual shift going forward, and also even also in the UK, if the Bank of England starts, the question only is when is the external shock hitting, or when is the recovery coming to an end, forcing central banks possibly to lower interest rates again before they're really gone to any kind of historic comparable higher levels that would have been necessary to really give them room to move again.
Yeah, Stefan, go ahead.
I think one interesting question, Marcus, remains is what's left in the toolbox if an external shock hits? I mean, I think we're already at, the maximum the central banks can provide to the market. But what's left in the toolbox?
And what is the effect on real estate?
Well, that's what I think, we've seen that at least some areas and some markets over the pretty rough crisis in 2008 and 9 have showed, tremendous resilience into the market. German resi, to name, of course, one. But I think, that's from my point of view, from an investor point of view, I think a very important question. So are the cash flows from your real estate investment are sustainable? And are they kind of crisis-proofed? I think that's an important question to answer.
Yeah, and I think that's it's not my job now. We just tell people how they got it right or wrong. But these are critical issues right now. Is there still scope for growth, or is it now the time to be hunkering down the portfolios, anticipating a downturn? So that's the big call. And I think from what you're saying earlier, you see the scope for value add and some opportunity for growth. And clearly that there could be in parts of Europe, but in other parts, maybe it's not. Maybe it's a time for hunkering down and thinking about the income stream. I think one of the interesting dilemmas right now is that as we're going through the recovery, NOIs or income, rents are starting to rise, incomes are starting to rise, defaults are starting to fall. So on the occupier side, it's pretty good, but yields are very low. Lease lengths generally are lower. There's a lot more uncertainty about the cash flow, and as I was saying earlier, that could cause problems because you've got much shorter certainty over cash flows if we have an economic downturn. So how to manage a portfolio in that context of the change in the nature of your income stream is a real challenge right now.
Yeah, did you want to pick that up?
Yeah, I think there's one thing that's comforting. I think a lot of capital sources that we talk to have learned quite a lot over the last 8 or 9 years. and have got quite long memories and can see some of the mistakes, at least, of what happened in 06, 07, 08. And we're hearing a distinct bias or increasing bias towards income-driven strategies. And you know, our business, we have to look ahead and see where investors will want to invest in 16 and beyond. And we're still dealing with managers who are sort of in and out in time managers, as I would call them. So can get the money in and out of the market within 3 to 5, maybe 3 to 4 years. But also we're focusing on things like housing, student housing, to a certain extent sustainable location logistics, and other strategies that will provide that recession-proof, hopefully, income. So you can hear it. You can hear the battle going on in investors' heads. You know, Christ, what should I do now? Because this is getting quite late. I think the fascinating bit is that the fact that the perception of how late is different around the world, and that will drive investors' behaviour.
Yes,
And I think what also is coming back is the interest in diversification. For a while after the crisis, we heard from investors, you know, it did nothing for us. All the markets kind of plunged at the same time. And now they're looking back in the data and see actually cities and countries performed actually very differently at very different times they got hit, the portfolios got hit. And also now, because, you know, Italy is for a couple of years behind the UK markets, they now can see again that the diversification across markets is of benefit. And some of the investments are now driven not by going into the market which offers the best return, but going into the market which offers the best diversification benefits compared to the portfolio you already have.